Today we look into what are stocks and shares. To get some early housekeeping out the way, in general, the terms stocks and shares are used interchangeably. The one difference you'll see is that you own shares of a company, but have a portfolio of stocks. Now, a share represents partial ownership of a company. Think of it as a company splitting out pieces of a pie. You may also hear the phrase having equity in a company, which is the same thing. The owner of a share has a right to their portion of the company's profits. Companies sell ownership in the form of these shares to raise cash which they can use for wider business. But where can I buy them? There are two main ways to buy stocks and shares. Firstly, an IPO or initial public offering. This is where a company sells its shares directly to the public for the first time to raise money. They will do this on an exchange like the London or New York stock exchanges. Secondly, shares are traded on the secondary markets, where over 99% of trading is done. This is where investors buy and sell from other investors when markets are open. So, what can owning a share do for me? There are two main reasons why most investors buy shares. Firstly, dividends. These are payments where companies share their profits out to shareholders in the form of cash payments, or sometimes additional shares. Secondly, price rises. When a company does well, their stock price usually rises with it. As you may expect, investors can make money if they sell at higher prices than they bought. Equally, it's important to be aware of the risks. For one, companies are not obliged to and don't always pay dividends. And their stock price also doesn't always go up. Frankly, it can fall much faster than it rises. Now, let's break down a few common phrases for you to understand. If there are any more you'd like to know, drop a comment and I'll reply to you. Market capitalization or market cap. This is just the number of shares multiplied by the share price and tells you the total value of a company. When you hear stocks called large cap, it just means companies with large market capitalizations. Another phrase you may hear is a stock split. This is when a company divides each existing share into multiple new shares. For example, in a 3-for-1 stock split, each share becomes 3 at 1/3 of the price. While market cap stays the same, this reduces the share price of each individual share, which make them easier for investors to own. Another phrase you'll hear is a stock buyback. This is when a company buys back its own shares from the market, regaining more ownership. Generally, it comes from a company in a position of financial strength. Earnings per share or EPS. In simple terms, this is a company's net income divided by total number of shares. For this metric, the higher the better, as it tells you how much money a company earns for every share outstanding. PE or price to earnings ratio. This is the price of a stock divided by the company earnings per share. This determines how a company is valued compared to other firms and is a commonly used metric by analysts. A high or low PE ratio is not a good or bad thing, but merely a reflection of how investors value the company's stock. I hope you found this video useful. If there are other videos you want to see in the future, be sure to leave a comment below. Have a great day.